Hi, everyone, and welcome back to my digital banking LinkedIn Live series. I'm Daryl Knopp, Senior Director of Portfolio Marketing here at FICO. This is number 3 in our 5-part series, focusing in on the 11 commandments of digital banking. And today we've got Kevin Sandhu, and we're going to talk through a couple of we're going to talk a little bit about a lot of other stuff around a couple of the commandments. First one, respect the data. And the other one, respect my time and match my effort, both kind of data focused and people focused. So as I said, I'm thrilled to welcome Kevin Sandhu, co-founder of Control HQ. Today is my guest. Who better to talk about the importance of data and control than him? But before we kick off, Kevin, why don't you tell us a little bit about yourself?
Sure. Yeah. Super happy to be here to talk about some exciting topics, at least exciting for me. So about me, I'm a financial services entrepreneur. I've spent the better part of the last decade in the fintech space. Control HQ is actually my second fintech startup. In my previous one is actually where I had the good fortune of working with Daryl. We covered a lot of spaces around, I would say, alternative data collection, some considerations of compliance, working with incumbents or traditional financial services companies. And so very eye-opening experience. Prior to that, I had a traditional finance background. I'd spent, again, better part of a decade in investment banking and private equity. Before that, I was a software developer. It's an odd sort of roundabout way. I actually studied electrical and computer engineering, but somehow ended up in the finance space. And so I always like to think fintech is my absolute sweet spot, marrying two things I'm pretty interested in.
Yeah, I think that's an interesting way to put it, because I certainly would. You are the merging of financial knowledge and technical knowledge, and so I'm delighted to have you here. Well, let's jump right in. You mentioned data, but never a bank's had more data than they do today. In fact, if you look at the Forbes statistic, and whether it's Forbes or others, the statistic is 90% of the world's data was created in the last 2 years. And if you think about all of the data that exists, it's amazing to think about that statistic. One of the things that I say when I'm talking about 11 commandments and other things is that, the data the customer shares with you is a tremendous asset and should be viewed as a gift, and a gift that you don't want to spurn. And so, how can banks use customer data to provide a better customer experience and deepen their relationships and loyalty today?
Yes, it might be an obvious statement, but I think one of the biggest challenges is not having what I think of as like a single source of truth, a central repository that's accessible by a reasonably wide audience of people within the bank, not strictly the IT department or software developers or those people with explicit roles in data analytics or data science, but all sorts of individuals in the business, the marketing team, the product team, really anybody that has a reason to better understand the customer shouldn't be experiencing a bunch of friction to access it. And so, as you said, there's never been more data, yet it is often overwhelming, it's often inaccessible, and it isn't a really cohesive view. And it's funny to me that then we have fintech companies like Control HQ and obviously hundreds, if not thousands of others that acquire this information to better or hopefully better service the customer. Maybe it's in the pursuit of offering credit that an incumbent would not otherwise offer. And the almost perverse thing about it is the data that we're using is often bank account data, transaction data. It is strange to me that somebody that has been a multi-decade long customer of JP Morgan feels underserviced by JP Morgan because in theory, there's a bit of an issue here where there's a poor understanding of the individual's cash flow, income history, credit history, and so on and so forth. And that we somehow play a data arbitrage by acquiring, amongst other things, that very same transactional data from JP Morgan to service this customer in a way that JP Morgan could. Now, there are slight differences. We may have a different view around our risk tolerance or how we want to service the customer, but this concept of data arbitrage, fintech startups pull data from incumbents that incumbents absolutely should have and be leveraging. And I think it really comes down to this idea of single source of truth, having a holistic view around that customer.
I think it's fascinating. For let me start and say, we're not picking on JP Morgan here. We're just using them as a
Right.
example, because actually they are my primary bank, and their app is actually pretty good. But I think the point Kevin's making here is an incredibly important one, which is for decades, or certainly for the last 2 decades, and then let's focus in on the last decade. The one thing that the large financial institutions have was this data advantage, but they have literally, in many cases, wasted that. And so now what's happening is with the advent or the maturity of bank aggregation, and then if we look at open banking in markets where it's regulated, we're now leveling the playing field. And so that thing that was an asset before that they didn't have to share is now being shared, and now you can actually develop these deep understandings. And I love the phrase data arbitrage, to develop experiences and products and tools that the large banks are having difficulty doing. So let's jump into kind of some of the variations of those themes. And so nobody likes to fill out forms and provide personal data. What are some of the things that you could use this data to, the banks could do to make it easier on the customers?
Yeah. So, essentially, I use the term, or we think about the idea of autofill. And I mean that quite literally as an autofill wherever, this information should be available. If I've been a customer for a decade, there's no scenario in which I should be providing my date of birth, for example. Now, there might be reasons like something like an address that I should confirm it because it's been some time since it's been confirmed. But my date of birth doesn't change. And if I've been banking with you for a decade, I don't expect to be asked that again. So that's a very literal concept of autofill. But even metaphorically, this previous point about autofill, that, for example, if there's an area where I'm meant to provide my last 12 months or last calendar year's income. Now that data also, we don't think about it as an autofill because it's not a black and white on hand, my date of birth type of information. But again, that data is effectively embedded throughout a lot of my transactional information, even if it's at least a rough idea. Incomes may be a bit tricky because the data that hits my bank account is net of taxes. And often as an industry, we're thinking about gross income for certain debt to service or DTI type of calculations. But again, there are these at least heuristics to say, it's not as though, Daryl, I banked you for 15 years. I have no idea. I got a completely blank box. How much do you make? There is at least some pre-population that can happen on the basis of that. And as a customer, not only is that convenient and saves me time, but it also reminds me, not so subtly, of the relationship we have, and that we are not transactional, but in fact, a relationship that spans many, many years. And so I think that's efficient and effective, but it also, I think, is just a wise way to strengthen a relationship.
I think a couple points, and something we talked about back in 2014 when we were kind of kicking Groupland, and what ended up morphing or rebranding into Grow is the two, like income as well as loan amount, right? And so income, we can literally, to your point, we can observe income. We don't have to predict it. We literally can observe it by looking at the transaction data. And if we want to confirm it, you'd be able to put up a number and say, hey, it looks like if I take the deposits from the last X months that your income is roughly this. Can you confirm? Confirming is something much more positive than can you put in your number, right? Because I have no idea, or that's the implication. And then I think the one that we talked a little bit about, and I think we tested at one point, is we asked people how much they would like to borrow. We don't necessarily, in the case of credit cards, ask them how big of a limit they would want, because that, while that's interesting input, it has no reflection on whether or not we're going to provide them that from an affordability standpoint. They might be able to afford only 10,000, but they want 50, or they might want 10 and they can afford 50. If you can offer them, it looks like you can borrow up to X, and if it's the number you want is less than X, and you choose the number. So there's all these nuances around that data. And again, I think the message that we send to customers when we have them fill in things is an interesting one, and one that's kind of a little bit painful. One example that I would give here is I opened up an Apple credit card about a year ago or so, and they'd been launched for a little while, so maybe some of the initial bugs were out, if there were initial bugs, but it was confirmation only. And then I have an iPhone and an iMac and an iPad and an iWatch, and so I've got they've got a plethora of data on me. And from beginning to end, I didn't, it was confirmation of data. I had a new Apple credit card with a pretty decent size limit in my Apple wallet in under 60 seconds, right? And the experience, even as a person who spent the last almost 30 years in banking, was crazy. Like, it was just so slick and smooth, intelligent, intuitive, which is a big deal. And so, no, I absolutely agree that, when we've got this data, once you're authenticated, right? I think we can all agree that strong authentication done in a proper way where people understand what they're doing. Once you're past that, when you're asking for things like, put in your date of birth and your current address, that's ludicrous, because you're past the authentication. So I'm not trying to confuse that we don't want to have good fraud prevention or authentication. It's that's a separate thing than, okay, well, now I want a product. Well, hey, boom, hey, here it is, right? It should be very, very simple.
And I think that last point, that this might shoot myself in the foot as a fintech operator, that in fact this data arbitrage shouldn't exist, that the experience should be far smoother with your incumbent bank. I mean, I've been my sort of house bank I've been with for at least 15 years, and it is odd to me that when I open a new product, the experience isn't that different than a net new
Yeah.
product with a new relationship. Certainly with a fintech that has often thought a lot about friction on the onboarding process. There's no way it should be that Apple experience that, as you said, because there should be this single source of truth, a unified data source that when I want to add another credit card, open up a bank account for my child, it should be 80% done by the time I've clicked on the one swipe. And it is odd to me that it's 3 minutes to open that account when in the same 3 minutes I can from absolute scratch start. And so I think that same point, authentication is friction. It's good friction because embedded in that friction is the actual fraud detection and so on and so forth. But once you're within those walled gardens, it should be far less frictionful with an existing relationship versus net new.
Yeah, it's a little shocking, and I think that for years, a lot of us old time bankers would blame it on things like regulations and legal requirements get done. And the reality is that that's just not the case. It's just it's the data's in silos. It's difficult to get to. They haven't built out a real customer level view of things, and as such, they get in some cases lazy and not pull these things together. And I think the brightest and best, the large institutions and small ones and fintechs that get it, and they do it amazingly well. Let's jump into the next. So, financial institutions continue to pivot and try new ideas in their digital transformation journeys. One of the things that's important to make customers feel valued with their time and effort that they invest in the banks. An easy way to do this is by updating customer credit scores. Is often seen the banks check them, making that information accessible without customers needing to request it. Working in the world of control, what are the specific needs that customers want to control, and what are the things they wish their banks could do more for them?
Yeah, so this is I think a little bit of a biased answer because Control HQ is really focused on a very specific kind of customer. And I was about to say a niche of a customer, and I actually didn't, because our thesis is that perhaps it's a bit of a niche today, but this is one that over time will be, I think, very mainstream customer. And it's really, for lack of a better description, we say independent workers. So you could think of this as a freelancer, a contractor, often one-time consultants or solopreneurs, but individuals that are not traditionally employed. So they're not W-2 earners with a 9 to 5 and all the things you would expect about a paycheck every 2 weeks, traditional tax forms, all of that. But it's also not necessarily a small business. Like these individuals that we service are in fact typically sole proprietors. Now, sometimes there's a bit of a niche around single member LLCs, which is a structuring nuance, but the intention here is that this is not an individual who has quit their 9 to 5 and said, I'm going to incorporate a business and I want to grow this business and get hundreds and thousands of employees and so on and so forth. This is somebody who says, look, I'm a software developer, or I'm a marketer, a designer, copywriter, whatever it might be. I like my craft, but I would like to do it on a more flexible basis. And I think that this trend has been ongoing, that there are more individuals moving to this form of work even before the pandemic, but the pandemic has undoubtedly accelerated this trend. For the last 2 years, all of us knowledge workers have, like it or not, become accustomed to things like remote work, virtual experiences, so on and so forth. And part and parcel of that is your day looks different. You don't necessarily have the same start time, end time. You probably have more flexibility to go to the gym in the middle of the day or drop your kids off at school or whatever it might be. I think all of us have sort of started to realize that maybe how arbitrary the work day and work hours are, that 9 to 5 is somewhat of an arbitrary split. Monday to Friday, in fact, is a bit of an arbitrary split. And so we feel like this has been its trend for some time. We certainly saw it in, I would say, lower income, lower skilled sectors of the workforce. This is the sort of gigification or Uberification of a lot of these commoditized jobs, the Uber driver, the Postmates runner, so on and so forth. But we're seeing this now to slightly higher skilled, higher income earning knowledge worker moving increasingly to this independent form of work. So I think this is great. And there's a bunch of reasons why we're excited, because I think it's just frankly a fulfilling, enjoyable way to work. We think this is DEI 101. This is inherently an inclusive way to work. It's right there in the title. Flexible work is inherently more flexible than traditional work. All the people who can't conveniently fit into the box of a 9 to 5, maybe it's working parents with young children or aging parents that they're caring for. It's people that are semi-retired, fresh out of school and upskilling. Everybody that doesn't fit in that perfect mold has a viable opportunity to have great, fulfilling careers in this more flexible way. The challenge, well, there are many challenges, but certainly from a financial services perspective, is this is a tough customer to service. We say that the independent worker is the new underbanked, and that's a bit vague. Really, it's under credit more than anything. Banking in general, sure, but when it comes to credit, this individual is difficult for us as an industry to wrap our mind around, because it might be that this person makes $100,000 a year, or maybe I'll pick a more rounded number. They make $120,000 a year. This is a relatively high income earning individual, perhaps in their late 20s or early 30s, well educated, increasing income levels. This is, from a financial services perspective, from a retail banking perspective, the most ideal customer you could imagine. Well educated, high income earning. They're going to earn more. They're going to go on to buy 6 or 7 figure houses, mortgages attached to them. They're going to build probably 6 or 7 figure investment portfolios, spitting out 2% MERs and these other like really high margin, interesting products that, as a Wells, as a JP Morgan, as any successful incumbent bank, I would want to build a relationship around. But of course, credit is challenging because the lumpiness of this income, the fact that gross to net income is not the same sort of attrition we would expect because they have a regular tax profile. They don't necessarily have multiple years of tax forms to look at. It's just a really, really challenging, I think, credit to wrap your head around. Therein lies, I think, the opportunity for someone like Control. So we are taking, hopefully, this unique perspective. We do consider traditional credit metrics. I want to be clear about that. There's, I think, a lot of folks in the fintech space that I humbly think throw the baby out with the bathwater. I think that there are traditional metrics that are incredibly powerful and decades and decades and decades of data to prove it. Things like FICO scores, absolutely predictive, accessible, low friction to access. But we supplement that with things that I think fill that gap, that while we can't look for paychecks, pay stubs, and traditional tax forms, we can, however, get real-time insight into cash hitting their account. We can even go up the funnel in our case to often look at invoice data. So we are truly predicting. We know what invoices are outstanding. We know your collection rate, that maybe 5% of clients don't pay or you settle for whatever reason. So we go high up in the funnel to see what kind of business are you in? What are you invoicing? What do you typically collect? Is there seasonality? And again, seasonality, if you look at it from our perspective, is fantastic. It is difficult from a credit perspective, but it's also fantastic from a use case. We can fund that seasonality. We can smooth out your workflow. And in doing so, build this very sticky, valuable relationship where you look to us as sort of the means by which you can pull off this hopefully fulfilling way of life. Now, so that's sort of our general view on broadly the space. And so what do we look for, or what do we think our customers look for? It's this flexible form of credit. In our case, it's unsecured, which is, of course, inherently the riskiest form of credit. But they're essentially trying to, we say that lumpy income is a feature, not a bug of this lifestyle. The lumpiness is exactly what drives the flexibility. If I want to take 3 weeks off in August to travel with my family, or I want to take parental leave with a new baby, that lumpiness that comes out as the downside is the reason why I got into this. But lumpy cash flow is a pain for all of us. You know, your rent or mortgage is fixed every month, your car payments, your groceries, even how you think about your savings plans typically tend to be on a fixed periodic basis, weekly, monthly, whatever it might be. And so our customers are looking for ways to smooth the cash flow in spite of sort of lumpy income. Now, that's sort of broadly the flexibility we look to offer. It does create some friction in onboarding, though. There's a lot of information we got to wrap our head around, and onboarding into one of our credit products is a little slower, a little longer. We have to inject more friction. There's more conversation, that sort of thing. Now, hopefully the customer sees the value, and we invest quite a bit. To that point, you said we've done a bunch of testing where we can get you onboarded in 3 to 4 minutes, or we can take about 5 with embedded video, as well as just floating notation that, you know, that classic question mark, you hover your mouse or your finger over that, it says, here's why we're collecting this information. We went so far as to actually embed short explainer videos. It increases the onboarding time by about 20 to 25%, but we're seeing actually better conversions because it is a more comforting process along the way. So these are sort of some of the learnings around it.
Yeah, I think the last one's really fascinating because as in the last kind of 3-4 years, I've opened up, I don't know, so I've got about 160, 170 financial services apps on my phone. And if I think to one of them, and I use the example all the time, Lemonade Insurance, and I use them for home insurance, but they launched a pet insurance program. I went through the process, and it was literally just chat inside the app. They only really needed 3 or 4 or 5 pieces of information: dog's name, breed, age, things like that. But they made it conversational, and making it conversational, it made it very intuitive, very comfortable, and almost, you know, jesting. And I'm talking with Maya, the AI, and it probably made it a minute longer than it needed to be. But I'll guarantee you the conversion rates were better because everything they asked for was an intuitive way. I understood what they were doing. people will provide you with information if you give them a good reason to do so. If you make them feel safe, right? You respect that the time they're putting in. And so, as you know, and as we discussed all the time quite a bit at Grow, is that the conversion rate's the thing. If you chase away good customers, you end up with a portfolio that might not perform the way that you think. The other thing that I want to add, and this is why I really love what you're doing. It's twofold. One is how do I assess the risk and the affordability? And then secondly, what kind of products do I need to design to meet them? And the example I would use, and I think you've heard me say this before, is you know, as you know, I worked in Japan for 5 years, and the Japanese have a bonus culture. You get these large bonuses. Most salary men get a large bonus in June and in December. So I was the head of lending for a bank there, and we had a mortgage product where you could sign up for that mortgage product, and you had 10 small payments and 2 large payments. And that seems kind of weird, but when you match that with the fact that they're getting these bonuses, all of a sudden this lumpy nature, to your point, had no impact when it was, you know, when it wasn't large, they had a smaller payment. When it was large, they had a larger payment. It seems like the most easiest thing in the world to think through, but there are no products in North America where you've got to, you know, we get bonuses at FICO in December. If I had a larger payment in December, it wouldn't be cumbersome to have that. So maybe I should have 11 small, you know, maybe my rent should be, or my housing payment should be 11 versus 12. And so I find it fascinating.
If you pull that out to this flexible worker, it's even more unpredictable. It's not every December. I mean, there might be some seasonality you can predict, but generally speaking, you don't necessarily know your lumpiness at the beginning of the year. And so the entire year is entirely unpredictable. And so ours goes so far as that our facility, it's a revolving line of credit, but there is literally no fixed repayment schedule. Instead, we programmatically monitor your income events through your bank account. And in months where you fall short of your sort of what we call baseline earnings, so let's say you come in, you're onboarded, we assess your baseline earnings as $7,000 a month. Any month that you fall short of 7,000, we programmatically and automatically top up that missing cash flow, and we automatically and programmatically repay the facility by the same mechanism, by monitoring and say, if you have a great month and you earned 8,000, to the extent that there's any balance outstanding in your facility, we then sweep some portion of that. But the key here is that we don't try to box you in saying, Daryl, are you sure that you can pay $600 every single month for this car payment for the next 60 months? And the reality is, no, I don't know. I know that over the 60 months, that aggregate amount, yes, but I can't guarantee you January, March, and February are going to look exactly like this. And so we adapt the essentially the repayment profile. Now this, I'm sure a bunch of people listening here already skin is crawling about not only the credit risk, but just the operational complexity around it. And absolutely it is. Like you can't predict the AM of this facility and manage the whole book.
If it was easy, everyone would be doing it, and that's the space that you've chosen. And I do agree with you completely that it's growing. Just watching the time here, let's get into the last question, because I know it's one that we've got some passion, both of us, around. You know, what trends do you see coming down the road in 2022, 2023?
Yes, I'll be very biased again, and I say that I think that the nature of, certainly in retail, customers is going to change a lot. And obviously, you know, this trend that I feel strongly about, that we're going to see individuals look less and less like the mold, that the retail customer isn't going to look like this W-2 earner with 1.7 incomes per household and, you know, buying a home typically between 25 and 35 years old and so on and so forth. I think we're going to see just a lot more heterogeneity amongst the customer base, even the concept of retail. We actually don't think our customer is a retail customer. They have elements about them that present the way that a small business would, just even the lumpy cash flow, the working capital needs. This is not a banking feature, but even taxes become quite challenging. This individual is a sole proprietor. It isn't necessarily economic for them to have a CPA on speed dial to constantly calling, yet taxes are a significant point of complexity. So we've actually built that into our offering, not something that you would think of as I think of it as a financial services offering, not necessarily a banking offering, but we also automate and programmatically remit taxes, both on a quarterly and annual basis on behalf of our customers. There's a little bit of a selfish reason. We also do that because as lenders, we know that even if you haven't paid your taxes, if you have an accrued tax liability, the government gets paid before we do as creditors. So it's in all of our interest. Yeah, exactly. So it's in all of our interest that you be caught up with your taxes. But nonetheless, the point is that, you know, we have picked off this particular example of it, but I think just generally we're going to see continued diversity amongst the way that customers look, and therefore one size fits all programs, credit programs or other programs, are going to be less and less effective. Now, historically, this has been a real problem because as you get away from a traditional person, it's not like we can run custom programs for niches. Like the cost to acquire this data has historically been incredibly high. It's not like it's impossible. You can sit down with a loan officer in 1984 and spend 3 days capturing this information and doing customer interviews. But for relatively small dollar unsecured credit, it just isn't profitable. And I think that's where the brave new world driven by software, it is now, not that the data has never been available, it's never been available this cheap and able to be processed in such real time. And I think that's the really interesting bit. Now, what scares me, obviously feel strongly about this, but what scares me as sort of a fintech operator is, the classic line that the race comes down to how fast can the startup scale versus the incumbent innovate. And I hope we can scale to a point where we've got a very defensible business. But the reality is, what keeps me up at night is not necessarily other fintech companies, but the incredibly well-run, successful JP Morgans and the Wells of the world, with their, to me, unlimited distribution in size and scale. If they start thinking and behaving like a little old startup like us, great for consumers, a little bit of sweat on my brow, but I think that'd be a really exciting outcome for the industry.
Yeah, I think so too. I think that the large scale adoption of this would be a fantastic thing. It's great to have you guys and your team kind of focused in on this. The one thing I'll let you think about, but I won't let you comment on because we're out of time, is that I'd love to see how you could do this across international borders, right? Because all of a sudden, because, you're in Canada, it's 35 million people. What's the number of people? And it is a growing group. But I think that challenge exists everywhere on the planet. And in some cases, much more so than here. I think if you think of Africa and data and not quite smartphones and other things, there's all kinds of interesting things here. Well, let's, again, thank you so much, Kevin. Thank everyone for tuning into another episode of my Digital Banking LinkedIn Live series. I'll be back next month to talk about communication and trust in digital banking. Please check our updates on the FICO page. If you're interested in learning more about the 11 commandments of digital banking, please check out the links below. Access to my ebook. And Kevin, thanks again for the great chat today. It's always good seeing you. Got to get up in Vancouver and get together for a beer again. Again, thanks again.
Thanks.